The chief executive of Lloyds Banking Group has warned that a tax raid on the banks in the forthcoming budget could harm lending to households and businesses. In an exclusive interview with Sky News, Charlie Nunn urged the chancellor to ignore calls for a windfall tax on commercial banks. He also said that proposals for a motor finance compensation scheme being planned could cost the industry 20 years of profitability. Charlie Nunn was talking exclusively to our business and economics correspondent Gurpreet Narwan on the sidelines of the government's Regional Investment Summit in Birmingham today.
So you're the boss of one of Britain's biggest banks, so you have this rare insight into how people are feeling about money. So how are we doing as a country? Are things really that bad?
Well, look, the macro view is we're in a very resilient but slower growth economy. We see real strength in many households and many businesses. In fact, the data would tell you that savings, real wages, and the capacity of households to spend on discretionary items is at one of the highest levels since the financial crisis. And the same for businesses as well. But at the moment, people aren't confident to invest and they're not confident to spend.
We look at the state of things. Persistent inflation, slow growth, a rising tax burden. Some have described it as an economic doom loop. Can you see where they're coming from?
That's not what we see on the ground. As I say, when you look at the average household in the UK, we've seen now 2 years of real wage growth. There's definitely households struggling to make ends meet, but the majority have seen a significant increase in their spending. We're seeing saving rates we haven't seen for a while. Debt levels are at low levels. And the same is true for businesses. What we're missing is a confidence in the future.
And so how do you build that confidence? Say you're the chancellor, you're delivering the budget next month. What policy levers would you be pulling?
We think growth is at the heart of it. Now, that's going to be a multifaceted set of tasks. One part is going to be the longer term activity around infrastructure, building out the future of housing, regulatory reform, and the agenda the government's put together. And that's hugely important for the economy in the medium to long term, but also households today and starting to get some investment going. The other part, which I think is very much in front of us, is to try and create this confidence to invest more, especially in businesses and SMEs across the UK.
Some would say that the banks could actually be contributing more. As you know, the sector's been making stellar profits thanks to high interest rates. If we increase the bank surcharge, returned it back to its 2023 level of 8%, that could raise £2 billion. It's money that would go a long way, wouldn't it?
We do make a massive difference to the economy. We have about £900 billion invested largely in the UK. What we think we need to get a healthy economy, you definitely need a healthy financial services sector. And if we're going to have the ability and the confidence to continue to lend into the real economy, to help households and businesses invest, we need to make sure that the financial services system and Lloyds Banking Group really remains healthy in that context and committed to that growth.
So higher taxes on the banks would stop you from doing that?
Yeah, I mean, obviously tax is a matter for the government to look at, but it's definitely one of the factors that impacts our ability to support the real economy in the UK.
Look, you're already facing substantial costs because of the car finance scandal. Lloyds Banking Group has set aside £2 billion to deal with potential compensation claims that come through the FCA's redress scheme. You're one of the most exposed banks, but you're not alone. Can the sector handle this?
Yeah, look, it's a really important question. The first thing to say is for our customers, as you say, we're well provisioned, and for our millions of shareholders in the UK, we think we've covered the financial implications of this largely, and we can focus as whatever scheme the regulator puts in place comes to bear to support our customers as we need. But the critical thing is when we look at the scheme that's been proposed by the Financial Conduct Authority, we don't think it's proportionate, and we do think it's a very broad scheme. And why is that important? It's important for the reason you say. Firstly, providing car finance to people who want to buy and sell cars is critical. 80% of families in the UK who buy and sell a car need some form of finance, certainly new cars. And we are worried about the burden on the broader finance industry. And actually 50% of that is car manufacturers, not actually financial services companies or banks. So that's the first thing. The second thing is just the investability of the UK. When you look at the implication of what's been proposed by the FCA, it's going to potentially take 20 years of profitability of the car finance industry. And what does that mean for investability in that industry and for other investors and businesses looking to invest in the UK? There's real concern that this is going to create an investability issue.
So what will happen? Will lenders exit the market?
But that would be our concern.
And what does that mean for customers? So if you're looking to buy a car, or you need to buy a car to go to work or to take your kids to school, will you be able to afford a loan? Are your prices or your costs going to go up?
Look, that's what we're concerned about. It's unclear for now that the industry is working fine. There's a consultation the Financial Conduct Authority is engaging on, and we're going to engage constructively with that. And let's see where we get to at the end of it. But our concern would be we need a well-functioning finance market.
But are you prepared to take it back to the courts if necessary?
Definitely too early to be talking about alternatives other than making sure the FCA have all the information they need to get to the right answer.
It's quite clear within the sector that there's quite a lot of anger about this consultation and the proposal set out by the FCA. Do you still have confidence in the FCA and in its chief executive?
Yeah, absolutely. I mean, this is a very complex issue that's been developed over a long period of time. The core for us has always been on this issue is that once we understand the law, how do we get to a proportionate scheme that's the right scheme for customers, that's close to harm, and that allows the industry to continue to operate?
But the FCA is kind of standing by this. They feel like the balance is right. And they'll point out that, yeah, this is a lot of money. You talked about the profits being wiped out. But the lenders broke the rules, and customers ultimately ended up paying more than they should have done, and they deserve compensation for that.
Look, where we've broken the rules, we definitely believe we should compensate customers. Of course, there's been one case brought to the Supreme Court, and the Supreme Court itself said that was an egregious case with a very specific set of multiple factors. At this stage, the way that's been interpreted by the FCA for consultation is that would then impact 44% of all agreements over the last 20 years and 14 million people. So we're not comfortable that's the right interpretation of the law at this stage, and that's one of the core things to work with the FCA on in this next 6-week period.